Hey everyone, hopefully having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So we're going to dive right in, take a look, see what people are sharing, and I'll share my opinions as we go through it. If you want to follow me at @Finance, and if you want to join our community, finding-value.com, I dive deeper into all these topics, looking for potential investment opportunities, sharing those opportunities with everyone in the community. And we also have question and answer sessions on the weekends where I can answer your questions, and I give midweek updates of what I think looks good and what I'm doing in the markets. We do have the coupon code special that is still active if you'd like to join and receive a discount. Coming down, well, the first one, I used to play baseball. I watched a clip. Everybody's saying this guy balked. A balk is when you throw to a base before you lift your foot off the rubber. He did not balk, in my opinion, but if you guys want to see that, you can see it. Breaking Atlanta, Fed GDP now is at minus 3.7% versus minus 2.8%. Now, this is data, and take this data with a grain of salt, even though that's a cliche. I think they're manipulating the data to whatever the heck they want to say. They want the 10-year yield down. So what they can do is they can try to engineer or change the data, do whatever the heck they can to get that stinking 10-year yield down. If they have to engineer a recession, let's engineer a recession. That's what I think they're trying to do. They also need oil to go down. The 10-year yield and oil are highly correlated. So if inflation's in the system, oil goes up, generally interest rates go up with it. They have to engineer this somehow. I don't know how they're going to do it. Oil's pretty tight, and we've got declining production in America, a little bit, flat to declining production. We've got inflation in the system. Demand for oil continues to go up. This is a tough spot that they're put in, they being Bessent and Trump, because they're trying to lower the 10-year at the same time that oil is below the cost curve. This is such a weird dynamic that we've got going on in the markets. I think they're manipulating every damn thing that they possibly can. Everything. I think they're in there. They were trying to manipulate gold, but they lost control of the market. I think they're still trying to hold silver down. I think they're trying to hold oil down or make it even go lower. The problem is oil gets consumed and burned, and it's gone. So I don't know how they're going to do it. This is probably another attempt. It's like, well, let's just crash the damn market, put us into a recession, and maybe that will help. The problem is they're spending too much on fiscal spending. Their fiscal spending is 8% deficit to GDP, and it's like 8% of GDP, I mean. And that's inflationary. It's stimulative. I don't know how they're going to do this. They're in a weird situation. They're backed into a corner. I'm not exactly sure how they're going to get out of this thing unscathed. I don't think they're going to get what they want, potentially, unless they blow the market into a recession. I mean, it's a possibility. Christine says global natural decline rates of oil is 15% per year, according to ExxonMobil. So we're at 104 million barrels per day today. Times 15% equals 15.6 million barrels per day lost each year without new drilling or investments. I think it was with investments, if I recall correctly, with ExxonMobil. The world will need these barrel additions. So non-OPEC global supply from new projects from 25 to 2030, some of this growth will be offset from natural declines in existing wells. And here is maybe 4 million barrels. They've got one and a half or so there, maybe a little bit over 1. So let's just call this 1, 1, 1, 1, and 1. And 1 here. And then a little bit of this will go to these guys to make it 1. So that's 1, 2, 3, 4, 5, 6, plus this is 10 million barrels over a 5-year period. We need way more than that. We need way more than that. We might need 40 or 50 million barrels to stay even. Do you see where the problem is now? We've got these projects in the pipeline for 5 years. We might add about 10 million barrels. Every single year, we're losing about 15%. And I think that's without investment. But let's just say the decline rate is about 8 to 10 million barrels per year. It's probably around 8 would be my best guess. So this is going to offset, if we've got 5 years, 5 times 8 is 40 million barrels that we need to add in projects to production to stay flat. Well, we're only bringing on about 10. Do you see the disconnect? That's a huge disconnect. If we actually don't provide barrels to the market and we actually get a decline, I don't know where the heck oil's going at that point. Because you're going to have demand going up and supply going down. And the gap that gets created and the demand that needs to be destroyed is leagues away from where we are today. I mean, leagues away. Leagues away. What's a league away? We're talking multi-$100 a barrel oil, because you've got this disconnect of one going up and one going back down, which then blows out as you go out into the future. So you have to go to demand destruction. The problem is each year you need to destruct more and more and more. You may have to, if we don't replace the barrels and we lose, let's just say this gap, we get a gap of 30 million barrels per day out at 2030. Do you know how ridiculous the price of oil would have to be to destroy that type of demand? To a 30 million barrel per day gap? And that's decline rates. That means that existing demand, not new demand, not potential growth. I'm talking about the numbers start getting ludicrous. That's all I'll say. They start getting ludicrous because we've never had a market that had to destroy anywhere near that amount. A million barrels to 2 million barrels will probably send us to $200 plus oil off that gap. 30, I don't even know what that is. It's off the page. And yes, we would go into recession. Yes, we would have a huge reshuffling of economies. Now, I don't know if these numbers are 100% right. 8% is probably where I would be. The IEA says it's closer to like 4 or 5%, but they're using the decline rates of oil on conventional fields that are kind of old data. The new data, when you look at shale oil and some of these new fields, their decline rates are rapid, much faster than 15%. Their first year decline rates are like 30 to 60%, depending on what field it is and all that. But it could be 40% decline rates, 30% decline rates that first year. So if your average of everything is 8%, and this is all the big projects that are coming online, then it's this plus spare capacity. And I am doubtful of OPEC's spare capacity and how much they actually have. So when I look out in the future, I'm going to say that between 0 and 3 years, roughly speaking, out forward, we are going to encounter a problem sometime in that time frame. And then pricing is going to go up. I'm not exactly sure how it gets fixed. We've got maybe some projects out there. We can maybe increase production a little bit, but the decline rates are going to eat us. They're going to eat us up. So I'm guessing that the problem will be recognized between 0 and 3 years, and the problem will come between 0 and 5 years. The markets are forward-looking by about 18 months. So 0 to 5 years is the gap that I give and 0 to 3 for people to recognize it. So 0 to 5 is when the event will occur in. 0 to 3 is when it will be recognized and people will start pricing it all in. And we could recognize it at any point. Between 0 and 3 years is when people will recognize, you know what, we've got a problem. Our inventories aren't building. And obviously things can slow down if prices go way up. Some analysts predict peak shale in the coming months, while others forecast modest growth in 2025. This is the disconnect we have in the market right now. It says, what is clear is this: the world has lost its the world has lost its most important source of meaningful short cycle supply growth. This is underappreciated yet massively impactful going forward. It is completely impactful. Here's one. Some data showing what could potentially occur. They're saying the peak is in May of 2025 of shale oil. 95% of growth came from shale oil the past like 5 or 10 years. So they are predicting that there's going to be a rollover and a decline in shale production. If that occurs, I don't think we can grow worldwide. I don't think we can. I think it's pretty much it. We hit conventional peak oil in the mid 2000s, and we came up with this unconventional production. This is what displaced a lot of the decline rates and added to growth for worldwide production. Now, can we grow production at $150 per barrel? Maybe. I don't know. We'll have to wait and see. But there's going to be a transition period if this does roll over, where prices are going to have to go up and incentivize new production. This one on the right is Rystad forecast. They have it forecasting going up quite a bit. They have peak productive capacity of about 12 million barrels per day for U.S. lower 48 onshore, and they've got October of 2026 is where that will come up to. So right now we are standing on top of predictions that people are making. Some predict that we are having a rollover like basically now. Others predicted that the rollover in oil specifically occurred a year ago. And then Rystad is saying, well, maybe it's still out in the future. Who's right? I don't know. 0 to 3 years for the market to figure out that there's a problem. 0 to 5 years is when the problem will hit. And it could happen anytime. It could happen this year. And if it rolls over this year, we have low commercial inventory, low SPR inventory. Everything's low right now. That would be a huge kick to the nuts for everyone, because prices are they're going to have to rapidly rise, and it's going to be very difficult to replenish inventory levels. The inventory levels have basically been depleted. Josh Young says, this is what did well the last time the U.S. experienced stagflation. The last time they experienced stagflation in 1970, we hit peak oil in America for conventional production. We had a rollover in 1970. And there are two things that are present in every single one of these bull markets. Well, there's mainly three things. There's three things. Here are the three things that are present in all bull markets. Increased inflation, where money's coming into the system at a faster pace than what supply can be provided for oil. Number two, oil rolled over in every single one of these cases. And it's like the markets kind of front run the whole thing. Another thing that I've noticed is that we rolled over in production of gold, and gold also went up during these time frames. And I don't know if these are by happenstance. The way that I kind of view it is money comes into the system at a faster pace than you can grow supply. And that's the added pressure to the system. And if the system can't respond, then money starts to rotate differently, because if you don't have a response in oil growth, it's going to be inflationary. So money comes into the system. It says, feed me more oil. Oil says, we don't have it. Good luck. and then the price of oil goes up and it gets priced into the consumer price index and everything else, because oil is the number one commodity. That is the mechanism. So the first portion of the mechanism is increased spending. It could be fiscal spending, it could be monetary spending. 1970s was monetary spending, and it was the baby boomers creating loans, monetary loans in the system from commercial banks. Today, I think it's being driven by fiscal spending. So fiscal spending comes into the system and says, feed me more oil. And then oil says, we don't have it. And then prices start to increase. So what I'm looking at is I'm looking at the supply-demand imbalances in oil and watching it like a hawk, because that has been present in a lot of these commodity bull markets. The only one that wasn't present in necessarily was a fast revaluation of gold in the 1930s, which repriced all of the commodities higher. So the best returns for an inflation-adjusted total return for the select asset classes from 71 and 81 was energy equities. REITs were good, treasury bills, utilities, S&P 500, corporate bonds, and treasuries all went down. And I think we're in the same exact situation. Fiscal spending is going to be driving it. Potential problems with our debt and interest payments could increase money creation from the fiscal side. As money enters the system, it'll say, feed me more stuff. Your demand is the money in the system. That is your demand. The credit creation. Doesn't matter if it's from fiscal or monetary. That's going to put everything into a shortage. It's going to say, feed me more oil. And if oil cannot perform, you've got a big time inflation on your problem. The best assets under that condition were energy equities and precious metals. Precious metals went ballistic because what happened was money rotated out of treasuries, out of corporate bonds, out of the S&P 500. Money was leaving those sectors and entering REITs, energy equities, and precious metals. And that's exactly how I basically set up my portfolio, is for this scenario to occur. So as we continue to go down, it says we're not running out of oil, we are running out of cheap oil. Not necessarily true. Cheap oil is energy return on energy invested oil. We're running out of oil that can support modern societies. That's not necessarily cheap oil, it's physics. So as oil starts to deplete, what we do is we high grade everything. We take the best possible oil fields in the world, we deplete those first based off of the returns. So conventional oil goes first. We start going to harder to get and harder to get places of oil. We are mining oil, or we used to, out of oil sands, and now we have developed some other techniques, SAGD, steam-assisted gravity drainage, to get oil in Canada and other places. But your energy return on energy invested has declined rapidly for the stuff that we are now getting. Modern society is debatable on how much energy return you need to make this stuff work. And you could also say that you could take a very high energy return on invested energy production source and convert it into fuel, and it would still be worthwhile doing. So maybe we will do some of that out in the future. So we're not running out of oil and cheap oil per se. It's running out of oil that gives us the returns to sustain modern society. And there's a big difference there. Money doesn't make the world go round. Energy does. Money is backed by energy. And money is a future claim on buying something. It's not final payment. So if someone gives you money, right? You're not going to keep money and be happy with money. You're going to spend it on something else. It's not final payment. Final payment is a commodity that's been dug up by energy, or It is a final product that is converted commodities using energy. So everything in this world is more or less a conversion of energy into things. I call this embedded energy. There are things in this world that require a whole bunch of energy to create. And if you were to create those things in a cheap energy environment, you might have a cheap price. If energy goes way up, the things that are really hard to build or that require a lot of energy to build are going to go up in price dramatically. Energy could see another leg up if the U.S. avoids a recession, says this partner. And I agree. I'm in the same camp. A lot of people are trying to predict a recession. The predictions have been pretty tough. And I think it's tough because they're running such large fiscal deficits. So there are people in one camp that says a recession is coming because they see certain indicators that are turning bad. Other people will say that's fine if the indicators are turning bad, but they're spending 8% deficits. And whenever we spend over like 2 or 3%, we don't get recessions. Who's right? I don't know. I'm empathetic to both camps. And what I say is it's difficult to know. It's very difficult to know which direction this is going to end up. But what I do is I don't focus on making predictions. I focus on where the value is in the market. Hence the YouTube name, Finding Value. You want to find the value in the markets. You invest in that value, and you try to stay away from making predictions. And that's what everybody wants. They all want predictions. Remember when we were selling SPR barrels, restricting oil drilling, and funding wind power projects with a $1.4 billion deficit? Fun times. I thought that was funny. It's just stupid. It's absolutely stupid. We've got the oil to gold chart. Somebody was talking about, well, what if someone made a comment? One of the things says, what if oil catches up to gold? It's like if it catches up to gold, we would break out of a falling wedge, broken out, and another falling wedge that we're trying to break out of. Then it would come all the way up, maybe to expensive oil. If we get up here, guys, oil is very expensive. What that means is, let's pull out the good old calculator here. If we get to 0.14 times, say, $4,000 gold, oil is at $560 a barrel. $560 a barrel. Now, is that a projection? No, it's just math of the ratio repeating what history had done in 2008. So we'd be at $600 oil if gold's at 4,000, and I just used a round number, and this ratio to repeat again right here, $600. Here is gold versus oil, and again, shoulder, head, shoulder potentially, and maybe we come back down. We would have to come back down to the lower end here for that 600 barrel price. If we come all the way back down to the neckline, it probably would be a few $100s a barrel then. Maybe not 500, 500 or 600. It'd be 250 or 300 or something. For the oil market, there are more reports of Indian and Chinese importers seeking alternatives to Russian and Iranian supplies, with tanker trackers reporting an upswing in West African flows to Asia. Everyone's hungry for it. This is what turns the world, guys. It's oil. Oil is the most important commodity. It's the master commodity. Really is. Is it finally time after 17 years? Energy sector index XLE breaking on out? It sure looks like it. It sure looks like it. This looks great. And yeah, I do look at this chart quite a bit. This is not April Fool's joke. This is real. Commodities are historically undervalued. The median is 4, and we are below 1 on this chart. What does that mean? We can go up 4x to get to average. We could do a 10x in commodities. Do you know what that's going to do to some of the equities? I don't think anyone has a clue here. They don't have a clue. You're going to see companies do 100 times returns. 100x. Now, which companies are going to do those 100x? It's probably going to be the small speculative ones. Very difficult to know exactly which ones will do it, but there'll be some that will do it. There'll be some that will do 1,000x in a 10-year time frame. They will outperform everything in the market. Paladin Energy, which is a uranium company, that did 1,000x from bottom to top last bull market. There will be others that do this, and it's coming. I can buy anything I want, but I can't buy time. Keep that in the back of your head. It lacks that same chilling allure, doesn't it? Serious delinquency rates among single-family loans, not all that high yet. It's still low. A lot of people are throwing around multifamily. They're trying to get an emotional response from everyone. I like Logan because he just responds with other data like, yeah, it's not that bad. Calm down. Christine's, yeah, we already went over that. Rick Rule says, I believe a replay of the 1970s in a financial sense is inevitable. You need to look at what worked in the 1970s during a period where the US dollar lost 75% of its purchasing power. The gold price increased 30-fold. I don't think it will increase 30-fold this time. It's possible, but gold was held down. Well, you could say it's being held down now, but gold did a 30-fold increase. So did silver. Silver did a 50-fold increase or more. I think those are going to be the best areas for protection with the lowest amount of risk. I think crude oil is going to be another spot that's going to do insanely well. Oil versus the money supply looks insanely good. So this is crude oil versus the M2 money supply. 3-hump consolidation. Clean is all get out. Falling wedge, breakout. We have another 3-hump consolidation that's formed, which is the falling wedge, ready to break out. I think crude oil is like, everyone hates it. I don't know why. I love crude oil. Crude oil is like, it's like everything in the damn market. And people don't realize that. You know, everybody's like, oh, tech. Guys, tech is more or less a way to play everything through efficiency. So tech is efficiency. What they've done over time is made things more efficient. So technology made phones more efficiently. A phone connected to the wall, which then became a wireless phone, which then became a cell phone, and then they kept improving communication. The thing that powers everything is energy. Energy is like the middle of everything. Everything else is around it. Technology is a piece of converting it into certain usable products and making things more efficient. But the problem with technology is that the more efficient you become, the more energy that people consume. So you're just going to go up vertically in consuming energy. As people become wealthier, they will consume more and more energy. Brent crude oil kicked off the bottom of the pool at 69, at 75 now, as it surges towards the light of fair value at over $90 a barrel. It depends how low we stay down here, or how long we stay down here. If we stay down here a long time, it's just going to kick higher over 90. The fair value is going to continue to go up. Physics remain undefeated. Inventories are drawing of oil just in time when demand is growing. Probably nothing to worry about. Those wind turbines better spin and spin hard. And this U.S. ending stocks of crude oil and petroleum products, this looks like a broken uptrend. And that we are now in a downtrend. Could be. If you draw a nice little line going across here. Another commodity to Dow ratio down here at no man's land. Commodities as a basket, GSG, looking ready for their next leg higher, oil included. And other commodities. Fertilizers, whatever else, copper. Cycle investment strategy, love it when fundamentals and technicals are coming together. I don't know what AVAL is. It's doing a perfect backtest of stage 2 on this. So stage 1's down here. That's that bouncing around. And then stage 2 is when you break out of this. This is going into stage 2. That's the uptrend. And this here is your stage 3, stage 4 decline. All of the commodity groups are all through here. They're either in stage 1 or in stage 2. They're just breaking out of it. Copper's broken out of it. It's sitting on top. So is uranium. There's oil is still back in stage 1. It's right doing an inverted shoulder, head, shoulder, and it's on the right-hand shoulder. So we're still in stage 1 for oil. The rest are mainly in stage 2. GDM miners, and these are these ones breaking out. So think of this as the basing pattern, and think of this as so stage 1 and stage 2 kind of breaking out like that. And that's ARCA Gold Miners Index. When I hear classic contrarian investing sayings like buy low, sell high, be a contrarian, buy when there's blood in the streets, be greedy when others are fearful, I think of the Palladium chart, dream setup. Now here's what's crazy, guys. I like this. First wave, second wave, third wave, he's got 2,111%, 2,111%. Well, from this bottom here, what is 2,111%? He's got another 2,111% move up. This time starting at 1,170 would mean a target is 24,700. Think about that for a second. Platinum will probably do as good or better too. We start to get to some outrageous numbers here. So if you start seeing these large numbers, $10,000, $20,000 gold, palladium up at 24/7 and platinum up there as well. $600 a barrel oil doesn't seem all that much. Seems about right. Now, here's the thing. If we get gold way up there, your ratio of crude oil to gold, if it were to go back to a normal level, you're going to have oil go way up. So everything is going to go up. It's kind of like you're in this stuff and you're okay. Otherwise, if you're not in it, I don't know how you can make dollars and get into the game if prices go to these levels. It's like you got to get into the game now before these moves occur, because your buying power is just going to get absolutely smoked. And that's what Rick Rule was saying. He's saying it's going to be like the 70's, where the dollar is going to lose 75% of its purchasing power. That's what's driving these big moves. These are all denominated in dollars. Here's GDX versus SPY. Did you notice that the precious metals miners did not follow the stock market down from its mid-Fed top this time around? I will repeat that. Miners did not follow the general markets into its weekly cycle decline. Instead, precious metal miners went the opposite way and put in a big up move from there. And this made the GDX to SPX ratio chart below break out. Means gold miners will outperform the stock market from now on. This chart below was also one of many charts that helped us catch the latest big low for PM miners at the service. Also posted in the post 3 weeks ago that the ratio gold versus SPX is now making a higher high after a huge purple breakout. Means that the breakout I posted on 2 years ago for this ratio is now confirmed. Been saying for years that capital is now rotating into commodities. The capital rotation turn is not coming. It's already here. Been posting many historical ratio charts, chart turns and breakouts in real time. The big ratio chart turns for precious metals happened long ago. They are not coming. See previous posts. Always remember that most have to be wrong at the wrong end of sentiment at major turns, breakouts, and levels. Always, including all analysts, experts, and services. And do think about what that means for how you spend your time seeking information and for who you follow. So we've got a big GDX to SPY breakout here. The false breakout was the move lower. And he nailed the bottom if they actually bought it there. That's what we were doing too. We were buying stuff all through here, cost averaging in, getting our shares for this bull market that is coming and that we are in. What happened to auditing Fort Knox to ensure the gold is still there? Good question. How come no one's talking about it? You think the gold's even there? You think that's why they're not doing an audit of it? Here's Rafi Farber. He says, it's real. It's happening in platinum too. TF Metals, this is not a drill. There are only 8,510 contracts worth of platinum registered on COMEX. Closing OI was 12,091. Someone bought 5,697 contracts at deadline. Something huge is happening right beneath our feet. It's all coming, guys. I'm already positioned in it. Let's get this thing ripping. I've got the gold to Bitcoin ratio, perhaps a double bottom. Could be. If Bitcoin is an extension of technology and you put gold against NASDAQ, gold's already broken out against the NASDAQ and it's going to start to break out against Bitcoin here, potentially. This is one to watch to see if we do get a bottom. Christine Guerrero says the official Trump beg for oil trip is coming. Yep. They're going to go to the Middle East, beg for oil. Please produce more. We need to lower the oil price. There are two types of energy investors, those who can do math, those who listen to the EIA. Choose wisely which one you want to be. Here's LNG construction. Canada compared to the United States, we've got Canada kicking it up in 2025 and onward, and U.S. is really kicking it up in 2025 onward as well. This is going to be very good for natural gas producers, both in Canada and in the United States. Be patient as takeaway capacity increases the price of natural gas. And that's where we're going to end it, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Use that special coupon code. I'm going to be releasing a midweek update, so that should be released on the website. You guys can check it out and find out what my opinions are. But that's what I've got for today. We'll catch you next time. This is Finding Value.